morning from our global headquarters in New York. I'm Manny Screnny. You're welcome to Bloomberg Brief. Let's set that agenda. Mexico and Canada granted a one-month stay of execution on tariffs as China delivers a calibrated response to Trump's opening salvo. Determining the course of war, Israeli Prime Minister Benjamin Netanyahu proposed to meet with President Trump at the White House. And an untamed AI demand, Palantir surges after giving an upbeat outlook. Infineon warns of the tariff risks. Good morning. Straight to the FX narrative. You can see here that it is all about the yuan, and that is where you are seeing 10% tariffs kick in. The opening salvo seems like a calibrated response, so a little bit of a shift in the yuan, which is down in the dollar there. Dollar Mexico, a virulent day yesterday, regaining some of its footing as we go into this 1 month pause in negotiations. Down 3% yesterday, and they turned it around. Wells Fargo says of the Canadian dollar, the loonie as it's known, is that it's still too little priced in for tariffs. How does that play out to the equity market? You have two reprieves for Canada and Mexico, and you have a live set of tariffs now, trade war live with China in the second Trump presidency. And what you have here are equity markets grappling. S&P regained most of its 2% losses yesterday. Do we know more about the Trump put? Do we know more about tactical tariffs rather than perhaps enduring tariffs? But still, the risk remains for a 5%, maybe even a correction, according to Laurie Calvasino. The bond market, it was all about flatteners yesterday. Here we are, 457 on the duration, which is up 2 basis points. We need to debate the differential of whether stagflation is still a very live threat. Some stocks we're keeping an eye on as well. You have Palantir, as I said, in the headlines. Soaring pre-market. The software company gave a forecast that was stronger than expected, fueled by the demand for, you got it, AI, up under just 18%. Spotify rising. Streaming company reports earnings before the bell today. Investors are looking for signs that it can keep its subscriber momentum and profitability. And BNP Paribas announced a new share buyback and a higher than expected dividend after a surge in trading revenue in the final months of 2024. And in just a few moments, we'll sit the risk agenda with Mads Pedersen of Human Edge Investments Technology. And later in the hour, Adam Posen of the Peterson Institute joins me. And an exclusive interview today for you on Bloomberg Brief. Barrick CEO, I should say, Mark Bristow, joins us from the mining conference in South Africa. But let's reset to our top story. China has retaliated to President Trump's 10% tariff, Beijing imposing 10% levy on oil and a 15% tariff on U.S. coal and LNG. Google also being targeted in an antitrust probe, and some other American companies also on the target list. But President Trump struck temporary deals with Canada and Mexico, and he's looking for the same with China.
We'll be speaking to China probably over the next 24 hours. China's involved with the Panama Canal. They won't be for long, and that's the way it has to be. If we can't make a deal with China, then the tariffs will be very, very substantial.
Joining us now is Oliver Crook on the road of tariffs. China's response, Oliver, let's just start there. It's been described by many in the market as careful, calibrated, and we have this window through to February the 10th before these tariffs actually kick in for the U.S. And that's the source of optimism here.
Yeah, I think that it very much is, Manus. And I think just to sort of set the scene for where we are here today, we're in the biggest port in Germany. So we think about the sort of trade, we think about the sort of billions and trillions of dollars in the abstract, but really it comes down to places like this where you're seeing the physical containers move. I mean, a third of these come from China, and it is exactly going to be caught in the crosshairs of this U.S. and China trade war. What I think is very interesting is that, yes, as you say, Manus, it has been a measured response. It seems that, Trump really wanted to dial up the rhetoric, really do up those 25% tariffs, and then just sort of dial them back. But really, what's also interesting is the way in which, not just with the Chinese, but also the Trump administration, you're starting to see these things overlap. It's not just about trade. You're seeing it also in antitrust. And that is a lot of the sort of vocabulary that the Trump administration has also been talking about with Europe. It's, yes, about trade, but it's also about regulating the big tech companies. So I think it also sets a precedent for what these next 4 years are going to look like, how these things are going to sort of bleed into one another. And I think it's also interesting to see that with the China and the U.S. sort of tariffs, another consequence consequence will be here in Europe. When you see sort of tariffs go up, for example, the Chinese retaliating against American fossil fuels, that will mean that potentially some of that LNG can come over here to Europe, which is obviously good news for Europe. The bad news, however, is that if some of these goods can no longer go to the United States, much of that capacity potentially gets redirected to Europe, and that is a major problem for Brussels, who's trying to struggle right now for getting their own companies competitive and competing against those cheaper products from China.
Oliver, I would say it's very much about spheres of influence, geographic spheres of influence to the north and the south of the United States. And it was interesting, the recalibration in terms of how President Trump described his conversation with Sheinbaum in Mexico and how he referred to Canada. What did they have to give him as a policy of appeasement?
Yeah, so I think this is really very interesting, Manus. I mean, listen, they got the deal, so-called. They got the delay of about 30 days, both of them to sort of put more border guards on each of the borders in order to secure the borders about, for illegal migration from the south and then illegal drugs on both ends. That is going to be the sort of first thing. But the question is going to be, obviously, Manus, for the Canadians, for the Mexicans, and for anybody who is negotiating with Donald Trump is what happens after a month? Will those demands stay the same? Will they change? And for companies that are trying to figure out their trade routes, who are trying to figure out making this very long-term planning, it does not create the environment of massive stability for these companies to do that, and that is going to have a long-term influence. It sort of shatters in some ways the sort of global order and the sort of stability that has been so absolutely crucial, particularly to countries like Germany, where for decades and decades it has been the main engine of growth. It has been able to export their goods and have that sort of global trade agreement, and that is going to be very, very sort of concerning for them, particularly as he's been teasing that, the EU could be next with 10% tariffs. That is going to hit hard right here in the port of Hamburg, the very heart of European trade.
Well, to use the president's own words, they've been very, very bad to us. Oliver, thank you very much. Great work, Oliver Crook, on the tariff trail. So the trade war isn't completely off. What does it mean for markets? Joining us now, it is Mads Petersen, CIO of Human Edge Investment. Mads, it's been a sort of a hectic 72 hours, maximum angst, to a moment of relief. When you see the kind of swings in policy risk, you've actually taken action to recalibrate your risk. Is that as a result of tariffs, or are you front-running the worst-case scenario?
Well, the tariffs is the last parameter, the last thing which makes us take the move, but we're following our investment process. The real thing which has happened is the positives have moved away. Inflation is no longer going down fast enough that it forces the Fed to cut. Trump has endorsed them staying at neutral, probably because he doesn't want to have a domestic war when he has a trade war. And we see that the positive drivers are not there. This is going to be a year of trade war, and we want to start the year. We had a very good gains in January, and now we want to be more cautious. But this is the flipping over point where we have moved from 100% equities to 60 in our portfolios. And if we look at the context, well, China has generated the world's largest trade surplus, and now they get the effect of that. So in a sense, it's more the basic macro, but the basic macro is driving the trade war. So it is a reaction to that as well.
When you look at the kind of FX volatility that we've had, which is the very first response muscle that we look at, it's the very first flex that you really see, and then you see the equity market down 2% and pulling that back. Did you learn anything over the past 72 hours about this fabled Trump put?
Well, I think we learned that what we already knew. I think the biggest thing we have learned the last 24 hours or the last 72 hours is that the world is still not prepared for Trump. And the world is, shockingly enough, the German politicians, the Mexican politicians, you can like Trump or you cannot like him. Americans have elected him. And they are not ready for his new vision, which is he will play all over the plate. You heard him talk before. He talked about the Panama Canal when he talked about trade. He plays the whole plate, he plays the whole game, and he wants to change the things. So the real shock is that the rest of the world is not ready for that still, because much of what Trump said, he has been saying for months and maybe years.
Yeah, I mean, the shock is that people are shocked. If this is his if this is his opening trade salvos, I put it to you that this is going to be a much more aggressive foreign policy. This is about spheres of influence to the north and to the south and here in the west of the globe. With that in mind, how much more defensive do you need to be from a tactical asset allocation? You look at gold at a record high, you look at a dollar at a 2-year high. Are those your natural levers of defense?
No, the natural lever of defense is the middle of the US government bond curve. We're buying 3 to 7 year ETFs, for example, 1 to 3 year US government bonds. If the Fed had been more stable, we could buy longer duration. But the things which will really go up if things go really wrong are the long duration US government bonds. There is 2 currencies in the world which are stable. There's the Swiss franc and there's the dollar. And the Swiss central bank has cut very much. So what will happen if things go wrong is the dollar will strengthen the US treasuries. And that we have seen confirmed now. So the other things will be too volatile for us. But we have reduced equities with, in some portfolios, 40% down to 60, and others from 70 down to 40. And we have reduced high yields back to neutral as well, taking off 30%. This is what I think is reasonable to do now. The world is still in a very good, as I used to call it, a beautiful transition into a very strong growth era. Yeah, so we still have a very strong global economy, but China can no longer drive their growth with export, and Germany has not grown for 5 years. It's much more likely Germany goes into recession than to strong growth this year. So it's not a great year for everyone.
Okay, the belly of the curve, 3 to 7 years and shaving on equity risk. Mads, thank you very much. Preparation for an uncertain future 2025. Mads Pedersen there of Human Edge Investment Technology. Coming up on the show, the Israeli Prime Minister Netanyahu touches down in Washington. More on his meeting with President Trump. That's next. Bloomberg Brief. I'm Manus Cranny in New York. The Israeli Prime Minister Benjamin Netanyahu is in Washington. It's for his first international visit to President Trump's second term in the White House. The truce in Gaza, which began just before Trump's inauguration, is ongoing, but Netanyahu faces pressure from within his own government to claim a victory against Iran-backed Hamas militant group in Palestine. Joining us now with the details is Kevin Whitelaw. Kevin, before he got on the plane, he was bannering this trip as being the first international visit and leader that Trump would meet at the White House. So this is about personal branding, but this is also trying to reinforce his cabinet around him, isn't it?
Absolutely. I mean, for, Benjamin Netanyahu has a lot at stake as he goes into this meeting with Trump. And Trump has something at stake, too, because obviously President Trump has put a fair amount of his own political, sort of capital into the ceasefire. He's claimed a role in it, and he really wants to be able to move past the conflict with Hamas. But for Netanyahu, it's obviously a matter of political survival as he still faces pressure from the right-wing parts of his coalition to continue to press the fight against Hamas. That will not go over well with Donald Trump, and Netanyahu knows he's never going to get a friendlier U.S. president than Donald Trump. So definitely they want to try to find some way through this that preserves the ceasefire while keeping Netanyahu in power. And I'm not quite sure how that happens yet, but that's going to be what's at stake there today.
Yeah, it's about progress to phase 2, although his lines before he got on the plane, it's about the progress on redrawing the map and making more progress. Talk to me about Scott Bessent. The Treasury Secretary, Scott Bessent, has been accused of breaking federal law by giving Elon Musk, now this is access to Musk and the Doge team, access to government and personal financial information, which the president pushed back against yesterday in the Oval Office.
I mean, that's right. This is a very unusual situation where we have essentially non-government employees, because this Doge structure is kind of outside of the government. They're not exactly all paid. It's unclear what the status is. They don't have security clearances as far as we know, but they've been given access to one of this very, very sensitive system that processes payments for the federal government. So we're talking enormous sums of money. And no one really understands exactly what they're doing there, under what authority, and, sort of whether this is at all legal. Donald Trump has obviously said this is all about trying to just understand what is going on and understand what's being paid. Obviously, getting a handle on the federal spending in the U.S. is incredibly complicated. But this definitely is, there's sort of no precedent for this at all. There's already lawsuits out there by the unions saying this is not at all appropriate. I mean, these are things that could career officials spend their entire lives learning how to do and to deal with and to follow the law. And so there's a lot of concern about what exactly is happening behind the scenes there.
Well, look, there were a lot of executive orders signed yesterday in the Oval Office, and one of them was to create a sovereign wealth fund for the United States of America. Larry Summers spoke to Bloomberg in November about the potential for a fund. Here's what he said then.
A broad-based sovereign wealth fund, a kind of slush fund for government to do what it wants, achieved by borrowing money, I really don't see the logic at all.
Now, I was listening to that news conference yesterday. Pedersen saying we're going to monetize the U.S. balance sheet. How are they going to do that? What is the plan for this sovereign wealth fund?
Well, I don't think we really know the plan yet. Obviously, most sovereign wealth funds are funded by sort of, like clear revenue sources, usually natural resources or some other kind of revenue stream. It's not really clear what Trump would actually use to do this, except for perhaps more borrowing, something he has shown he'd like to do. He floated the idea of maybe using it to buy part of TikTok or buy TikTok for the U.S. government. I mean, he's floated a lot of different ideas. We're going to see over the coming months what kind of plan actually shapes up, but it is something that an idea that Trump had floated a while ago. So there's going to be some, there'll definitely be an effort to make something happen. I think we need to be pretty skeptical about the size and scale of what actually will end up materializing here, though.
Yeah, everything was floated yesterday, from TikTok to vaccines, multiple of things that could potentially go in a U.S. sovereign wealth fund. It's the funding of it that counts. Kevin, thank you very much. Kevin Whitelaw there on the very latest political machinations from Washington. Coming up, Palantir soaring after what it called untamed demand for AI. Unleashed, untamed. We'll tell you what that means in just a moment on Bloomberg Brief. Front page news from around the world. Let's kick it off with the Journal. They're reporting the Trump administration officials are weighing a plan to dismantle the Department of Education. That would shut down all functions of the agency that aren't written explicitly into statute or move certain functions to other departments. The White House didn't respond for a request for comment from the Journal. Next up, the Financial Times leads with Citi CEO Jane Fraser there. This is a bit of a move, telling employees they can go back to working at least 2 days a week from home. Fraser pledged to maintain the hybrid work schedule. This comes even as other banks up their in-office mandates. That's what you call capitulation. Bloomberg, we're leading with Palantir, giving a full-year revenue forecast that exceeds the estimates as a result of AI demand. The CEO, Alex Karp, described untamed organic growth. What is untamed organic growth? This stock was up 340% last year. Tom McKenzie will fill me in. I mean, look, we know these guys are big in defense, but wow, what an order book they've put in front of us.
Yeah, exactly. They see sales of $3.75 billion US for this year, well above the estimates. In the most recent quarter, they saw revenues increase 36%. They've seen a 45% increase in terms of sales to the US government. If you want an example of a company that's getting the ROI on AI, then it is Palantir. They've invested in the software around the defense capabilities that they supply into the US government. Every single arm of the US military now uses this software, as does Ukraine, as does Israel and other allies of the United States, and they are benefiting from that. And that line really stood out, didn't it, from Alex Karp in terms of that untamed organic growth. He also commented, by the way, on Trump, on Doge, on Musk. He sees all of those efforts around cost cutting as actually benefiting Palantir longer term.
That's what you call being well prepared for the press conference. Morgan Stanley's just up the price target at $95 from 60. And then you take Infineon. I think this is interesting, Tom, because if you look at the quarterly forecast from them, ahead of the analyst estimates, we caught up with the CFO, and this is what he had to say about tariffs.
A major escalation of the tariffs is not included in our guidance because we still are not giving up in advocating for free trade. We do not see that as positive for the industry. So an escalation of tariffs and counter tariffs would be negative.
So, Tom, just caught up with Mads Peterson there 10 minutes ago, and he said, look, the world industry is just not prepared for what's going to come at them, whether it's trade or politics. If you look at Infineon's numbers, I mean, there's a certain naivete in terms of not going deeper into the tariffs, but what do they tell us about the base demand here at this juncture minus tariffs?
Yeah, and look, maybe that naivety will come back to bite them, particularly given their exposure to the auto sector and the weakness, or at least the challenge to the auto sector as a result of tariffs, if they come through for Mexico and Canada, on now, of course, on pause. So that potentially is a key risk for them. But this is also about expectations. We come into earnings for the likes of Nvidia with very high expectations. The expectations were very low for Infineon, given their exposure to the autos, to industrial space, and essentially they more than matched those very low expectations. It's still a challenge, still soft in terms of quarter-on-quarter sales into the auto sector were down about 11%, but they seem to be managing their inventories better than some of their competitors like ST Micro. They are also getting a bit of an offset in terms of the demand coming through for data centers. They're benefiting from that as well. So the stock, the last time I checked, up double digits. Over the last 12 months, it's flat, but in terms of the inventory story, it seems to be improving, but you're absolutely right to point out they have yet to price in the impact of potential tariffs.
By the way, they're not the only ones to sort of leave tariffs off the modelling that they give to the market at this stage. Tom, thank you very much. We'll get Google's numbers later today. We'll bring you those as they break. Tom McKenzie in London. Coming up, impact scenarios of President Trump's tariffs. Adam Posen of the Peterson Institute joins me to put some context where it matters on Bloomberg. From our global headquarters in New York, I'm Manus Granny. You're welcome to Bloomberg Brief. Let's set that agenda. 1 month stay of execution on tariffs for Mexico and Canada as China delivers a calibrated response to the Trump tariffs. Determining the course of war, Israeli Prime Minister Benjamin Netanyahu prepares to meet President Trump at the White House. And an untamed AI demand, Palantir surges after giving an upbeat outlook. Infineon warns of tariffs risks. Good morning. Straight to the FX zone is where we look for the reaction function. You've got the yuan down by 0.3% as 10% tariffs go live and China goes for a calibrated response to the opening salvo. So a very small weakening in the currency. The Mexican peso regains its footing. They have a 1 month pause. They've got time to negotiate. That was down 3% yesterday. So that's coming back to par. And the Canadians, who Wells Fargo say the loonie, which it's colloquially known as, you need to be a little bit shorter of this as there's too little tariff risk priced in there. To the equity market, you've got two reprieves, one on Canada, one on Mexico, and calibrated response from China. So the equity market at the moment is flat. The S&P regained its losses yesterday. The consensus is now building that these tariffs may be more tactical than enduring. Your risk is a 5% drawdown. And Mads Petersen of Human Edge has just said, look, we're shredding our equity exposure across the portfolios because this world is just not ready for what Trump is going to do. To the bond market, and this is going to be, again, a recalibration. Yesterday was all about flatteners. The short end up at one juncture by 8 basis points, comes back to flat. 425 is where we are. What are your risks here? Downside growth shock, and therefore less upside inflation. So maybe it is a little bit more about flatteners. Let's talk and get a little bit of a recap on these tariffs for you. If you're just tuning in at 5:31, China has hit back. 10% tariff on oil and agricultural machinery, 15% on coal and LNG, and a probe into Google, amongst other companies. For Mexico and China, they have 30 days until the levies kick in. I'm pleased to say Adam Posen is the president of the Peterson Institute. He joins me now for International Economics. Adam, good morning to you. I'm not a game theorist, but 72 hours have passed of where we've gone from max hubris and pulled back from the brink. How important is the signaling that we got yesterday over Mexico and Canada?
I think we have to look, Manus, at this as signaling of intent and of risk and not focus on whether Trump gets to declare victory or Mexico or Canada gets to declare a reprieve. I view this as sort of a test balloon establishing a sense of uncertainty and fear. I view this as a potential prelude to the Trump administration trying to pass legislation to put wide tariffs in as part of the tax code. And I view this, particularly with the tit-for-tat retaliation from China, as actually the beginning of some asymmetric conflict between U.S. and China. As you noted, China's putting an investigation into Google. It's naming various companies to their version of the entities list. They're not going to stick with just tariffs the way the U.S. is not stuck with just tariffs.
For me, this comes down to actually spheres of influence to the north and the south with Canada and Mexico, which is about policies of appeasement that they've offered. But I want to just drill a little bit more into China. Step one is a 10%. There is a window through February the 10th. You say don't be lulled into a false sense of security about the calibration from China at this juncture.
Yeah, I think China had, during Trump 1 and in various other contexts, has pursued a very, I think, reasoned or reasonable approach to these things, which is pretty much WTO consistent, which means proportionate tit-for-tat tariffs, but then always having a bit of a kicker. And the kicker that they've put in this time with the Google threat and with the entities list and with the restrictions on certain exports like tungsten, that is a level higher. Now, again, is it a huge deal for the U.S. economy right now? No, but is an indicator of where we could go. That said, I think, Manus, what you touched on is Trump seems to be out to create a Fortress America. Whether that's a Fortress North America or a Fortress USA remains to be determined, probably trying to make it at least a Fortress USA Canada. So I think I'd be more worried about escalation returning on that front than I am about China in the near term.
Okay, that's interesting because what we saw yesterday was, I would say to you, a policy of appeasement by Sheinbaum and by Trudeau in terms of troops, a small number of troops in the scheme of things, Adam. But talk to me about this foreign policy move. You and I, as we walked out the building, I talked to you about Disraeli in the UK in the 1900s, and I put it to you that that is what this is, splendid isolation for the USA.
Yeah, I think that's a good classical reference that's relevant. I wouldn't focus, again, it's true that President Sheinbaum, Prime Minister Trudeau, both of them managed, although President Trump obviously acceded to this sort of kabuki game of doing things they already wanted to do and letting Trump claim victory, something similar to what Colombia did over the deportation flights. But that doesn't bind Trump in any way going forward, and that doesn't change the underlying pattern of interest. It's possible this is all just theater. I think that is underestimating the intent and power of the American president.
So, Adam, do you think there's a real risk that we go back to those maximum potential tariffs, not maximum, but the initial tariffs, i.e. 25% on Canada, 25% on Mexico? Do you think that's still a very real risk, because that's got consequences for the Fed and stagflation?
I think there's a very real risk that come April, there's going to be a 10 or 15% across the board tariff proposal through the Congress, and that there will be punitive tariffs continuing to be placed on Mexico. I think the 25% tariff on Canada is much less likely, especially assuming a change in government.
And the driver of this, you say, and we qualified this is about legislating these tariffs within the tax bill. What is the consequence of that, and how important is that for the deficit?
It's a double-edged sword. So if President Trump's administration gets the Republican majorities in Congress a across-the-board tariff, then it counts for the calculation of projected revenues when they have a reconciliation bill, which is Washington speak for how to get a bill through the Senate on the budget with only needing 51 votes. And so estimates done by Kimberly Clausing and Maury Obstfeld at the Peterson Institute suggest that a 10% or 15% across the board tariff would get you on the order of 1.5% of GDP a year in revenue, which is real money. It's still only a fraction of what lengthening and restoring the previous 2017 tax cuts would do, let alone the other things President Trump talked about in terms of tax cuts. Those start at $4 trillion and go upwards from there in 10-year costs, but it would be a meaningful number. If they legislate it, they get to count the number. If they don't legislate it, they don't officially get to count the number, though they'll claim the revenues, because then there's always a chance it could go away over the 10-year window. The flip side of this, though, is if you do the 20% tariff, 15%, 10%, whatever it is, if it's across the board legislation, then Trump doesn't get to do the bilateral bargaining and negotiating he's doing right now. Now, in theory, of course, they could put on the 10% across the board tariff and then on top of that, threaten additional tariffs. But I think that would be, in addition to harmful, it would be unwise in terms of the inflationary impact from a political perspective.
So this comes down to global positioning as the absolute power in this intervening period between now and the potential, as you say, for legislating the tax. So this is about posturing, global posturing of the second Trump administration.
And I mean, every time you do a government action, you generally have a half dozen reasons why you do it. And so I think you're right, Menace, that's the main purpose. And like you said, splendid isolationism, Fortress America, whatever they're going for is clearly in that direction. But additionally, they want to show domestically that they're willing to beat up on Mexico. They want to show the world that they're willing to rescind a trade deal like USMCA that Trump himself negotiated. They want to put fear into Europe, which isn't quite posturing. There's some reality behind it. And I fear that they want to establish, just as they're doing on many other fronts as a tactical matter, some amount of numbness or normalcy around this kind of attacking allies. And that is, I think, again, harmful and ill-advised.
Adam, time is always ticking down on these meetings. I know that you're a believer in hikes later in the year. Briefly, before I move on to the weaponization of this, are you even more convinced now of the propensity for hikes?
On balance, a little bit more convinced, and we've seen now a couple members of the FOMC start to say they're worried about the inflationary aspect of this. The only reason, and so I remain pretty darn confident of my call that by September the Fed will be hiking, but there is an offset, which is if Trump does do what I've called overdoing it in the short term on tariffs, or for that matter on migration, he could cause a recession quickly, in which case the Fed then has no choice but to cut. And so I do think there's a risk, not so much from the tariffs per se, but if they do this across the board tariff, it's a major shock to real income for low-income families. It's a real change in who pays taxes, and that could cause a consumer-led recession. But I still think they're probably going to hike.
Yeah, well, there already is a blue-collar recession. The ability to take price rises from the shops is more limited. Let's close with a much broader concept, and I bring this to you from Mohamed El-Arian on his LinkedIn post yesterday. Adam, let me just read it to you in context. The weaponization of trade promises, immediate gains for the U.S., but sustained over time, it risks eroding America's central position in the global economy and encouraging other countries to look for alternative systems it can bypass. I don't think this is a 2025 story. I don't think this is the next 4-year story. But I think Mohammed has a point here, which is the more that these are wielded around, the higher the risk is of a serious recalibration of capital and a real challenge to exceptionalism.
I think that Mohammed has a point that a lot of people are making, and I think it's wise. I think it's a little too flowery, and there are things that are going to happen over the next couple of years. As we saw with the auto industry cratering in UK after Brexit, we're going to see something similar in the US, that basically you will get some industrial inflows for people producing just for the US market, and trade will grow increasingly outside the US and outside, to some degree, China. And so you'll have Europe, Southeast Asia trade, Southeast Asia, Latin America trade, and you have a US that exports basically nothing in the manufacturing sector because it's going to become increasingly uncompetitive despite the energy subsidies. And those facts will take place in relatively short time if the Trump sustains this program, and before the sort of systemic cosmic stuff. I would also suggest that trade, and this is consistent with what Mohammed and others are saying, that trade is actually less vulnerable than movements in capital and movements in people and standards. And one thing I've been emphasizing the last couple of years is if the U.S., as it started to under Biden, but much worse if Trump pursues this policy mix, shuts itself out of all international fora, then the power that goes with being the standard setter, whether that's about intellectual property, whether that's about specific technical needs, whether that's about export controls, starts to erode.
Yeah, I mean, this is about the challenge to the exorbitant privilege, and we've already heard the president challenge the BRICS in terms of, you make any moves and you will do it at your peril. I want to qualify a couple of things that we've talked about. How quickly could we pivot from this exuberance that we have at the moment to the risk, and I understand it's a tail risk, of recession if President Trump goes over his skis, so to speak, in terms of aggressive policy, trade policy?
I wouldn't put it as a tail risk. I'd put it as 25% and possibly rising. And so it's a minority risk, but it's not just a tail risk. And that could happen quite quickly. If the risk comes from the change in tax incidence and fiscal policy and not directly from the tariffs, then it's probably 3 to 6 months away, because it's going to take 2 to 3 months more to get the budget through, and then for a while for people to believe it and feel it. And initially there'll be exuberance probably in the markets because the change in tax incidence will be seen as positive for profits. So I think it's a 6-month horizon, but once it turns, it'll turn.
Okay. As you say, you've brought it up from the tail to 25%. I was being generous. Adam, thank you. Thank you very much. Adam Posen there of the Peterson Institute for International Economics with us this morning. Other stories trending on your Bloomberg terminal. This is what we've got. The Treasury Department accused of breaking federal law by giving Elon Musk's Doge team access to a trove of personal and financial information. The White House confirmed that Elon Musk is a special government employee and has abided by all applicable federal laws in his role. President Trump signed an executive action directing officials to create a sovereign wealth fund for the United States. Treasury Secretary Scott Bessent and the Commerce nominee Howard Lutnick would spearhead that effort. The fund would be created within the next 12 months and could be used to facilitate the sale of TikTok. UBS is aiming to buy back $3 billion of its own shares this year. It plans to repurchase $1 billion worth of its own shares in the first half of 2025, and an additional $2 billion in the back half. CEO Sergio Motti spoke to Bloomberg earlier.
We are well prepared in terms of what it means for us in terms of risk management or capital management. That's the reason why we run a balance sheet for all seasons. But eventually, a bank is potentially going to be affected by second-order effects. What does it mean to the economy, and in turn, what it means to our clients?
Coming up, an exclusive interview with the Barrick Gold CEO from mining conference in South Africa. It's Bloomberg Brief. I'm Menace Crenny in New York. Let's get to Cape Town now, where the leaders in the mining industry are gathered for a conference at Indaba. Bloomberg's chief Africa correspondent, Jen Zabazaja, is sitting down with the Barrick Gold CEO, Mark Bristow, for an exclusive conversation. Jen.
Yeah, Manus, good morning to you. As you did say, we are here with a number of mining executives, and I'm here with Mark Bristow, the CEO of Barrick Gold. Mark, great to get you on set. So I wanted to start first with what we're seeing globally and the effect that it's having on gold prices. Record upon record upon record. What's your outlook for where bullion goes from here?
You know, as you say, Jennifer, everyone's trying very hard to push the gold price up. You know, what we're seeing is, continuation of de-dollarization, fueled by the actions coming out of Washington and the White House, and on top of that, we've got challenges in the UK. Europe is not in good place, right, with the French and the Germans, the leaders of of the free world, all in a crisis, and of course Middle East and conflicts in every continent. So, gold price has got a lot of upside still. I always say the risk is on the upside, and it's very much intact, that trend.
How much further do you think it has to go? Because some people believe potentially we've peaked.
Everyone has been saying that. You've seen the equities have been softer than the actual bullion price over 2024, but I don't think so. And certainly, I mean, there's a lot of reason why the gold price shouldn't go down. And
why?
And because it's when you try and if you try and look at what it's going to take for us to get back to normality in the global economy today, it's not an easy task, and I think we've seen damage to the US dollar as a reputational currency, and gold has taken that place. And I think what we've also seen, and a lot of people, because I'm sure it's your next question, bitcoins and all those are not stores of value. They are trading instruments. So gold has really arrived as the ultimate store of value, and people are buying the physical. What we've got to do in the mining industry is catch up with the price of gold.
Well, and I want to talk about some of the trends that we're seeing in the mining industry, one of which being M&A. We've seen a lot of that potential activity at least starting to happen. Is your expectation that will hopefully strengthen the mining industry and get to some of those goals that you're just mentioning there?
So M&A really, we need consolidation rather than M&A, because we've got too many companies running too fewer assets.
Right.
And so you need to consolidate, whether it's in the mid-tier, bottom tier, or the big players. But I think what it's really telling us is, as an industry, we haven't invested in our future, and we're now seeing what we saw back in the early teens of this century, in that we're chasing growth, inverted commas, through acquisition, and we're paying big premiums for them.
Right.
And higher gold price makes it look good for a moment, but things normalize.
What does that mean for Barrick's assets then, and especially on the African continent?
All the assets are very valuable. Whatever assets you got, particularly if you're in gold and copper today.
Right. So you're not planning to exit any of the operations?
Definitely not.
Okay.
No, we constantly look at our core assets, because I'm very focused on high quality tier 1 assets, and so there's a market for those non-core assets. But we're a long-term player. We invest heavily in growth, organic growth. We are pointing to a 30% increase in production by the end of this decade, organic growth
at all of your operations
across the group, and that's going to happen without any issuing of shares. In fact, we're buying back shares.
So when are you going to start buying back shares?
We have already started.
Do you plan to continue doing that then?
Absolutely. Certainly where the share price is sitting at the moment, one of the best investments we can make is buy back our own shares.
What do you think, where do you think the share price then has to go?
I think it's got to go up.
Okay, yes, but then what is your goals then for that?
I think, that's the market will judge that, and at the end of the day, what we've got, and we're about to bring out our 2024 results, we have one of the strongest balance sheets in the industry. We were able to buy back our shares, and we're investing all the time in new opportunities. And more importantly, we're about to build out 2 really big mining projects, the expansion in Zambia, doubling production, and then the big gold and copper asset in Pakistan, which is one of the biggest gold and copper mines that haven't been developed yet in the world.
And Mark, I also want to talk to you about another one of your operations that's in Mali. There's been a lot of focus on what's happening, the discussions between the Malian government and also Barrick. What is the next shoe to drop? Where are we at right now in negotiations?
Jennifer, it's been a very sad time for me. I've been in Mali since it was really re-established as a democracy, and I've worked with all the governments since 1992, and I think Mali's got itself in a position where it's really trying to shake out some short-term cash out of the industry, and this industry is the very foundation of its economy. And I think we need to, and so communication, to your point, is really important.
Right.
We are in communication. We are working we're making progress, not as fast as I would expect it, but I'm sure everyone is a little cautious because that's what happens when you get on the wrong side of everyone.
So you haven't agreed to a number or to paying back any of what?
No, we haven't reached an agreement on anything yet, but we are making progress, and I think that's the positive of these engagements.
Thank you so much. We have to leave it there. Mark Bristow, the CEO of Barrick Gold, joining us here at Africa Mining Indaba. Manus, back to you.
Jen, thank you very much. Great conversation there with Mark, stalwart of the mining industry. In Cape Town, let's take a look at the rest of the day. You have got a little bit of data. Jolt's data hits the tape at 10 a.m. Eastern time. And then we count down. There's a plethora of Fed speak. Bostic, Daly and Jefferson through the day. Let's see what they perhaps say about the risk of tariffs. The Israeli Prime Minister Benjamin Netanyahu will meet President Trump at the White House later today. But there's really only one gleaming stock that we're focused on at this pre-market. Palantir extending their double-digit surge, I should say, after the CEO talked about untamed AI demand on the back of their strong results. So that's up just under 20%. The surveillance team will take you through the next couple of hours, talking about tariffs and the risks to markets on Bloomberg.